Hi, everybody. It's Barry McGuire here for Barry McGuire's Creative Real Estate Education Group. It's the Monday main event. We gather at 5 p.m. Mountain every Monday, and we talk about creative real estate, all things creative. And to help out, we often have lots of experts on. We've had CMHC, MLI experts in the persons of Garth Chapman and Neil Shopsowitz. We've had development experts on, financing experts on, foreclosure experts, accountants. All of them have something to say about creative real estate. Of course, all of those are available on YouTube if you didn't catch it the first time around. My wife Donna and I also put on focus workshops, what we call focus workshops, and thank God they're live again after all this time of doing virtual ones, which is okay. But we did wholesaling, all-day wholesaling event in Calgary about a month ago, and we were in Toronto about 3 weeks ago doing agreements for sale, which now are coming of age in Ontario. Happy to say we've got lawyers there that will help out, which is a really important part. And of course, we've got our ever popular and amazing Rapid Cash program coming up on May 27th and 28th in Edmonton. And Donna will give you some information as we roll along if you want to take a look at that. It's really good. Now, today, we're going to talk about one of the Rapid Cash program, one of the RCP topics, which is rent to own. Rent to own is a very popular topic because it's a creative strategy where you can make money much more quickly than you can with buy and hold. We love buy and hold, but it carries on for a long time. Rapid Cash, it's in the name, folks, are strategies where you can make money a lot more quickly than that. And rent to own is one of those strategies that does work all across the country. Now, helping us out today, we have Andrea Warkentin, one of our focus team members. We also have Neil Taniguchi, who's going to be along to provide additional comment. Andrea is going to lead the charge today. And so we're going to bring in Neil and Andrea, and we're going to get started with saying hi to them to start with. Andrea, Neil, how are you?
Great.
Good. How are you?
Good? All right, we're good. Getting rained on here in Edmonton, which is important for my garden and for all those fires we've got in this part of the country. I know when you start hearing that we're having firefighters come from other provinces, you know that it's trouble. So I'm really hoping that this rain and tomorrow and the next day will cool things off a little bit. Now, I guess I don't know if we should talk about the Stanley Cup playoffs in Toronto. I don't know if you guys know that Neil's a big Toronto fan, having being an Ottawa boy. No,
9 days of elation to.
All right. So Andrea Warkentin is leading today. Andrea is a longtime associate of ours, a focus team leader that shows up at our focus workshop events and helps us out. And Andrea, since you're leading the charge today, I want people to hear a bit of your story right from when you were in British Columbia and what you were doing there, how you got yourself to Alberta and to where you are now, because quite frankly, I find your story really interesting, really fascinating. So before we get started, let's hear your story.
Well, thank you, Barry, for the kind introduction. So I am from originally the Vancouver area. That's where I went to high school, where I went to university. And then after completing university, I went straight into the Vancouver City Police Department, where I served for 6 years as a police constable and eventually a detective. So I went from policing to moving to Alberta, all because I joined the Real Estate Investment Network back in 2005. And I learned all about investing in real estate in Canada. And back then, all the focus was on buying in Alberta. So my husband and I decided to move to Alberta with our 2-month-old daughter. We bought a fourplex, lived in it while we were fixing up all the units and got it re-rented out. And at the same time, values of properties were going up dramatically, and we were able to refinance our fourplex that we still own today, pull out some equity, and buy more properties. Then, once I ran out of our money, I started partnering with people who had money but no investment knowledge in real estate, which quickly led to when I met Neil Taniguchi and his lovely wife, Linda, when we all took a course together in 2009 about creative real estate strategies, which is also where I met you, Barry. So through the years of doing creative strategies, bought lots of properties with seller financing, paired a lot of those seller financing with rent-to-own exits, did the occasional fix and flip, although it wasn't a huge focus for me, and basically got to the point where I was managing properties for other people, then became a realtor, both residential, commercial, and now a real estate developer out in Cranbrook, British Columbia, with my own mutual fund trust. So it's been an interesting ride over the last 20 years.
That's such a great story, folks. That's starting from moving from Vancouver to Red Deer, and I just love that. Buy the fourplex, live in one unit, fix the other units, refinance, and then just follow the chain as you did, to the point where you're pretty far up the real estate chain, being a real estate developer in BC. So it's such a great story, folks. And I wanted Andrea to tell that story because she knows of what she speaks. And today we are going to talk about rent to own. And Andrea is going to give us some details on some of her own purchases and own rent to own deals that she's done in the relatively recent past. And she's going to use a spreadsheet and share her screen. And we're going to walk through some of those examples so that you can see how you can make some money and what you can do with rent to own, because it's really fine for us to say creative strategies, do this, do that, agreements for sale, fix and flip, wholesaling, rent to own. Come on, folks, you got to do it. It's one thing to say it. It's another thing. And I really like talking about actual situations, actual cases, actual deals where somebody says, okay, this is one I've done and here are the numbers and this is what happened. So that's what we're going to do today. And Andrea, what's our next step here in starting to hear about what you've got to tell us?
Well, Barry, I'm going to do my best to share my screen. Can you see that, Barry?
Let me see. I don't see it as yet. Yes, I see it now.
Okay, perfect. So this is a property where sometimes when we do seller financing, which I purchased this property with seller financing, and the numbers at the time were a little tight. And so when we have properties where we're not quite sure that it would cash flow, but could make a good rent to own, because now you don't have to account for repairs and maintenance and vacancy and property management, that type of thing. And that was exactly this scenario. So a business partner of mine who was doing some marketing in the Red Deer area, Red Deer, Alberta, they came across this family who were moving from Canada back to South America, where they were originally from. And they had got themselves into a bit of a pickle. So they were up to date on mortgage payments, but not on property taxes. So they owed quite a bit of property taxes. So that was their kind of financial struggle. They had tried in the previous 6 months to sell their property, and it was maybe listed a little bit high because they had to account for paying realtor fees and paying out all of these taxes. So, my business partner came along, he met them. I went to the property and kind of closed the deal. That's one of my specialties is explaining seller financing in a way that makes people feel very comfortable. And so we did the deal. So we ended up purchasing this beautiful, huge 4-level split in a great area of Red Deer. It was a little bit dated, but we purchased it for $333,000. we paid $9,000 in property taxes. We covered our fees and the seller's legal fees. And then we put together a $5,000 reserve fund. So money into this deal was $17,000. And what I did is I actually found a joint venture partner to put in the $17,000 so that I had no money in the deal. So our total upfront costs, including our reserve fund, was $350,000. So we built out what the numbers would be over 2 years. Now, in this particular deal, with the 2 years, I'll just move this a little over, we were going to be charging basically just enough rent to cover the mortgage, the taxes, and the insurance, plus the monthly accounting fee. So our cash flow was not super high, just in charging the market rent portion. So for those of you who've heard how rent to own can be really lucrative because people are paying over and above the monthly market rent. Yes, that's totally true. But I like to do my spreadsheets as if those folks are putting it in their own bank account rather than giving it to me, just to be on the conservative basis. So this is what I did on our spreadsheet. So we had cash flow of $94 a month. And this is where I say some of these deals where you're not really sure that you're going to cash flow, they make good rent to owns. So we gave them a price that was not much higher than what our costs in, because we anticipated that we would go into a second year of a rent to own. So we had a small lift in value of $6,700, and we had $9,000 of principal pay down and a little bit of cash flow. So then if we sold the house in the first year, then we would have some legal fees and an approximate mortgage payout penalty. So the return on investment year one was just shy of $11,000. And so for each half of the partnership, it was $5,400. But because the investor was only putting in $17,000 and nobody had to qualify for a mortgage, the return on investment was pretty nice at 32%. Now, when we get into the second year, we're still charging the same monthly income, still have the same current mortgage. Property taxes may have been a little bit higher. But in any case, this is where the jump in price arises. So now we have a $17,000 plus lift in the price. We still have principal pay down and we still have cash flow. So the return on investment goes from $10,000 to $27,000. And for each person, that's roughly just under $14,000. So it gives a return on investment of 82% for just that year. So the combined return on investment between the 2 years was $114,000 for my money person. Now, Barry, things don't always happen the way we think we're going to. So we marketed this property and we got this lovely family who had just bought a business that they were going to be starting. So we anticipated that they would be a 2-year rent to own. And they, we found somebody very quick. They moved in within a couple of weeks and it was great. They were always paying their rent early. And it was interesting. They actually qualified in the first year. And I love it when people are successful. It meant, however, that my investor only earned 32% return on investment. So he was a little miffed that he didn't get his 82% on the second year. However, he did get the return of his capital, plus he got another $5,400. So typically you would expect a 2-year, and it actually happened quicker. So, this is what happens sometimes. We have people who are super successful, which I think at the end of the day is important. So I just wanted to share that first one with you. Now I'm going to adjust my screen here, but
okay, Andrea, just a sec. Before we move on there, the notion of the notion of the early exit and your investors going, well, gee whiz, I wanted that 80% plus return and all I got was 32. But I'm with you. We like it when people are successful, and that's a real win for your tenant buyers, to be that their business is going so well that they could qualify in 1 year rather than 2 years. So
Exactly.
overall, folks, we love it when this happens, even though sometimes it's not as good for us. Generally speaking, in the greater scheme of things, it's better if it's a win-win for everybody, because that just generates more stuff. So I just wanted to throw that in, and back to you.
Okay, so let me share my next example.
Okay.
So the next one is actually a tenant first rent to own. So I met the rent to own client just completely by random happenstance. So she had come to our open house for the last deal I just told you about. And she explained what her scenario was, because I always like to chat with people and find out, well, why are you interested in this specific house? So she said, well, I'm actually interested in a different house, but I don't think that I can swing it because I tried to buy it and I got turned down for a mortgage, but this is what I actually wanted. And I said, okay, here's somebody who's got a $10,000 down payment. They've already chosen a house and it's in a reasonable price point. I'll just find somebody to joint venture with me. And that's what I did. So sometimes there's happy little accidents here. So this one is a townhouse without no condo fees. So I like to build out spreadsheets, as you can see. So we purchased it for $273,000. I put in $2,000 for the deposit, which covered the closing costs. And then we had a $95,000 down payment. Now, what's interesting is, as you know, Barry, oftentimes once we kind of get close to hitting that financing wall as an investor, they want you to put a higher down payment down. And that's exactly what happened to my joint venture partner. She ended up having to put a 40% down payment, but she was still in, and we're going to see why. Okay. So she put down 40% down payment, and then she qualified for the mortgage. So she didn't really want to tie up that much money, which I understand 40% is a lot. So what we did is we brought in another money partner who put in some of that money so that she had less into it. So now I have two money partners. And so I decided to take a cut on my 50%. So the second person that came in, they have 17.5%. And I have 32.5%. So I decided to do it to make a win-win for everyone, because the person that put in the most amount of money actually also qualified for the mortgage, which I appreciate. So with this, we have our monthly income and then the mortgage, property taxes, insurance, and the monthly accounting fee. So our cash flow is actually pretty good on this one. It's about $400 a month. And then we increased our purchase price by 5% over what we paid. Our annual principal pay down just over $5,000. Our annual cash flow almost $5,000. And then I put in the 3-month penalty and legal fees in case she qualified in the first year in my first year's numbers. So we would have had at the end of year one a total return on investment just under $22,000. So then I split it out by everyone's percentage. So it's funny because sometimes people get confused how we calculate return on investment. So I'm just going to gently remind everyone. We take our return on investment, in this case, the $10,987, and I divide it by their original investment of $61,000 and change. So end of year one, an 18% return on investment. Now, this actually ended up going into year two. So year two, our monthly income, mortgage, everything's the same there. but we get an extra 5% increase over the 1 year price. So we have another $14,000. We've got more principal pay down, more cash flow. I don't need to account for the penalty and legal fees again. So we have a 24,000 and change return on the second year. And then it's approximately a 20% return on that specific year. So when I combine all of this together, my 50% partner is earning $23,000 in change, which represents an average of a 19% return. And my second money partner, same return, even though, because it's all proportionate. So this was another way of somebody being super happy with a 19% return on investment, very conservative play. If we had to sell this property today in Red Deer, it would sell for very close to this rent to own price. So I'm not worried about the tenant having any difficulty qualifying. So that's another thing to just point out there is sometimes we can be creative with how we structure things so that it's a win-win for everyone, especially because this was a unique case with the 40% down.
That's a really interesting thing for people to know, because everybody wants to put up as little money as they can, but putting up the 40% chunk was the way to get this deal done. And then when you have to bring in another investor, as long as people can see that it's a conservatively run arrangement, and as long as they have some confidence in you as an RTO operator and your knowledge and your ability to put the deals together, it's not a hard sell to say to them. I mean, as you're talking to them, you can say, the way we work these, you're going to probably do at least 12% on your investment. And then as you work your way through it, it comes up to be 18 or 19%. And that's, folks, anybody who's listening, all you have to do is one damn deal where you put one of these together and do exactly what you said you were going to do for your joint venture partners, for your investors. And those people will invest with you for life. They will, the next time you have a deal, for sure, if you email them and say, I've got something else similar to the last one. Are you interested? Absolutely. In fact, Neil, I think you've run into situations where you're closing out or rent to own or other creative deals, and you tell people and you're going to give them back their money. And what do they say to you when you say, I'm giving you back your money?
They're always like, we don't want our money back. Can you please find somewhere else to put it?
Yeah.
It's even better when it's in the times when the stock market has done its thing that it does every now and then, when it does its roller coaster. Mm-hmm. Gut-wrenching roller coaster ride was some verbatim words that I learned years ago that I use on a fairly regular basis when I talk about the stock market with people.
Well, and for the way we've been over the last while with extremely low interest rates, if you just kept your money in the bank in a savings account, you weren't getting anything. Even if you bought a GIC, you weren't getting very much. GIC rates have been, relatively speaking, pretty good lately. And I just got a notice from my bank that one of my GICs where I've got some money parked is maturing, and they're offering to renew it again for 3.25%, 3.25, which is, relatively speaking, pretty good, because you couldn't get anywhere near that. But on the other hand, if you start out saying we're likely to earn about 12% on your investment, and it turns out it's 18 or 19 or 20% each, by the way, that wasn't split, that was each, then that's why a really solid rent-to-own deal is extremely interesting to investors, extremely interesting. So, Andrea, as you were going through your spreadsheet, you talked about the specific details of these two rent-to-own deals. Now, I'd like you to talk a little bit more. Maybe you and Neil can talk a little bit more about, and you mentioned it briefly, why acquiring a property, either as a buy and hold or buying it by way of an agreement for sale or buying it in some other way, doesn't necessarily work on the acquisition side, but you buy it in order to exit through a rent to own, which does really work. So maybe we can talk a little bit about why what looks like a crappy deal just to buy and do something normal with it can be a good deal. Neil, do you want to talk a little bit about that part?
Sure, Barry. I know when we first started out, Rain in the days used to use what they call the money funnel. I was reading online the other day, someone says there's the 1% rule, where if you take the purchase price of the property, in a perfect world, you'd like it to generate 1% of that per month in rent, which would equate to 12% annually. It's almost darn near impossible to find. I think the reality of that is, more in the 6.5%, 7% range today. You might find something that does that. And if you buy the right suited property, you might get back into that 8% that we were buying, 8.5%, 9%, 10% in the day. Short version is there are so many properties that don't hit that minimum bar in terms of would you buy this as a buy and hold rental property to make it work, where there's the possibility that they're going to be even just barely cash flowing, like Andrea's first example, versus negative cash flow. If you have a property that's close to break even, Andrea in her examples, it's probably pretty smart, doesn't talk about actually the cash flow may have been better than what she showed in those sheets, because she was probably getting option credits monthly from the tenant buyers. And that's how you can take a property that is, say it's only a 3 or 4 or 5% property. You wouldn't ever buy that as a buy and hold, but you can take that property and put it into a rent to own situation, because the average consumer wants a different product.
Well, that's so important for people to understand and see that when you acquire a property and think you might have to run it yourself, you have to allow for vacancies, and you have to allow for repairs and maintenance, and you have to allow for a whole bunch of other things that if you're then turning the property into a rent to own, those folks believe and want to be homeowners. They want to be homeowners, and they're prepared to take on all the expense of being homeowners, which allows you to get rid of those money sucking expenses that you were going to have on a buy and hold, and it moves over and is quite happily taken over by your tenant buyer. So folks, we wanted you to see that a property that doesn't work for one strategy can work very nicely on another strategy like rent to own. And we're likely going to see more of this, because I think Andrea has another example for us.
Before that, we've got 2 questions.
Oh, Donna says we have a couple of questions. I don't see them on my screen, Donna. So there we are now. How does this work with current interest rates and nothing other than a condo less than $500,000? Sounds like somebody who's in another market than Alberta. Well, Andrea, do you want to take a run at that one?
Well, she goes, I'm going to dig. I think I have an example from previous. You go, Andrea, I'm going to dig.
Yeah. So a great example is a lady named Kelly Fry, who works in the Vancouver Lower Mainland. And most of her rent to owns she does in Chilliwack and Abbotsford, where the prices are lower, so that she can find people who can afford it. But even some of her rent to owns are in the $700,000 mark. But people are used to spending that higher amount, and they're trying to get desperately into these higher price markets. And so sometimes people just have to go further out to the bedroom communities. To expect to do a rent to own in downtown Vancouver is probably not a great expectation. And so I think that a better strategy is to find bedroom communities outside of the larger centers where you can offer a rent to own.
That's exactly right, Andrew. We've heard that from our friends Neil and Rachel Oliver of Clover Properties in Ontario. Neil and Rachel have done, I think close to 500 rent-to-own deals. It's a full-time business for them, and they find properties for their folks in places not in downtown Toronto, a little farther out. Facebook user lives in Chilliwack. and well, isn't that a perfect answer if for our Chilliwack
No, we don't know the exact
viewer?
market.
We don't know the exact market, I know, but Andrea's comment is well taken, that you in higher price markets, everything isn't over the moon. Everything isn't as much as it is in downtown Toronto or downtown Vancouver. But folks are used to, and have been used to for a long time, paying much higher prices than the rest of the country. And so lots of properties buy and sell both in the lower mainland and in Toronto and close into Toronto. So there are ways to make it work even in those more expensive markets.
Okay, we have another question.
Now, another question coming up.
Oh, sorry.
I think the other thing to just mention is you don't always have to do a single detached home. So you could do rent to owns like we did on a townhouse. So, it doesn't always have to be the top of the market.
No. And there's lots and lots and lots of condos, both in Toronto and in Vancouver. And so plenty of rent owns being done for condos. Neil, what did you find?
I found the slide from when we were on a couple of weeks ago, Barry, and let me see if I can figure out this share screen.
Present, says Donna.
Present, share screen. How about that?
Well, we'll see. I hope.
I can't
You
see.
have to click on the screen that you want to share, Neil, when
You have to find that one.
Not yet.
Can you see us? How do I pick it? Oh, hang on. Now I got it. This is what happens when you have too many tabs open, folks.
Neil is Mr. Tab, everyone. He's keeping a tab on everything going on.
Is that the one?
No, not on my screen. Donna, what about yours?
No.
This is going to be worth waiting for.
In the meantime,
In the meantime, says
I can share my next one if you want.
we still have some questions.
Oh, is there more questions, Donna? Okay,
Yeah,
let's have them.
Okay.
See what we got here. In the
Yes.
first example, was it structured as a 2-year agreement for sale? That's
Yes.
why you need to come to RCP. All right, Andrea.
Yeah. So one of the reasons we like to use 2 years was we find most people never do it in a year unless it's a very specific scenario, like somebody who's in the middle of a divorce and the divorce is close to finalizing. And as soon as that's done, funds are released from the sale of a marital home and they'll be able to purchase. So typically we just do a 2-year. And most of the time people take 2 years, not 1 year. So that's why we always do 2.
Okay. Very good.
Okay, if Neil wants to try again.
Neil, are you going to try again before
Okay, let's see if I can get this right this time.
He's got it there. I just
Share screen.
Donna says you did
Share
have it.
screen. Entire screen. My goodness. Technology. I think that's it. Share. There. How's that look?
Nope.
It looks like the three of us.
What the heck?
Okay, one more question while he's
One
doing
more
that.
question.
I'll grab it as soon as I see it now.
Praveen says, I have one pre-construction freehold detached home coming up for closing for which I want to consider doing an RTO. It is in Ottawa. Okay, we got your screen up there. Neil, we'll do this question, then we'll do it. It is in Ottawa, and currently the builder is selling $40,000 less than my purchase price. Oh, the falling prices have caught you. You're paying $40,000 more than the guy who bought last week. How can we structure this for RTO? Andrea?
Yeah, well, I think the important thing is that you got to figure out a way to kind of recoup your immediate loss. And so rent to own could be a good strategy for that. So I would specifically choose somebody who's likely a 2 to 3 year rent to own in order for you to, first of all, recoup the first 40,000, but then maybe recoup another 30 or 40 more because it's a larger market. So, the appreciation will be much higher than it is in Alberta on the average product.
Yeah, that's a good point, Andrea. If we the longer an RTO goes, as long as you can apply a reasonable price acceleration. Your examples had 5%, but it's dependent on the market. Even with a smaller appreciation rate, if you can have it go 3 years, then Praveen, as you saw from the earlier slides, you really start to get the gain once you're out of year 1, and especially into year 2, and then really nicely into year 3, and maybe it's year 4 if it works. Although we don't like to do them for too long. Okay, that's the question. And Donna says one more question.
Move on to the next set.
One more question. Then we'll take a look at Neil's slide, and then we'll go to Andrea's last one. How important is it to line up the seller's mortgage end date with the RTO end date? Neil, do you want to take that one?
I think it's in theory, it's a great thing. Quite frankly, a lot of times it just doesn't quite get there. And that's because, how do I put it? There's always, rarely do they qualify on the exact day. So if anything, you want to have them qualify, yes, in a perfect world when the mortgage matures. And this is, by the way, back up a step. This is if we're buying a house on agreement for sale and then selling it, or even with your own mortgage, quite frankly, if you have an underlying mortgage with a joint venture. You want to have it line up with the maturity date, or maybe even just after the maturity date, so that if you know what's happening, you can move it into an open mortgage where there is no payout penalty. Or if it's in the last year where there's only a 3-month, basically the answer is you want to do it to minimize your payout penalty. And if it lines up that it all falls on the same day, I would quite frankly say take that as a bonus. Like to say you're going to design it this way versus the reality of it is probably the best way. So we do a lot of variable rate mortgages, which hasn't been great in the last years. Everyone knows who's on them. But for that reason, because we got trapped by it, but for the longest time, it was the way we were working on it, because we only wanted a 3-month payout penalty for rent owns.
Okay, well, that's a good answer. Really, the open mortgage at the underlying mortgage maturity date is the way to not get locked in again and have a big penalty.
Yeah, the rate goes up, Barry, but in theory, you're not going to have that property that long when you know that they're on the cusp of qualifying. Yeah,
they definitely charge you a lot more interest, but if it's going to close in 3 weeks, it's acceptable.
And then I'll chip in something also quickly on Praveen's question in Ottawa. From what I was doing some reading, it seems that a lot of the other markets, some of the real estate investing type sites, and not even investing, just the ones that are more housing based, are talking that they're starting to call April as being perhaps the bottom or near the bottom. So remember, Praveen, that if you're looking at someone for rent to own, it's because they can't qualify today. So the pricing that exists for them to buy today doesn't really matter, so to speak. Yes, it's a basis for them to look at that unit and say, well, I can buy that unit today and your price is $40,000 higher. But if you do some quick math for them that says if the market recovers, which is more when in a lot of cases, this also gives you a guaranteed price in that 2-year time frame or 3-year time frame that it takes them to get there. And if the market goes up from there, we have people who are qualifying today that they're picking up 50 grand equity just the way the market bounced here unexpectedly in Alberta.
Yeah, no, that's a good point, Neil. So this is our slide from.
This is for the Chilliwack person who was asking about how do I do this on a $500,000 property. This was a slide that we did up for a presentation, you and I, Barry, a couple of weeks ago. And it was on a property first. So a property that was purchased for $400,000. And they had $10,000 down. I'm wrong. And I found an error from the last one. Your seed capital would have been $80,000 because you would have had 20% down, less 10 is 70,000. We had done that slide a different way as buying the house as a foreclosure and doing a mini, almost like a burr on it. But for the purposes today, you can buy a $400,000 property. I ran these at current rates. I think I used like 4.85 on a 5-year rate, and showed that basically if you had $1,850 of rent, and quite frankly, in Chilliwack on a $500,000 condo, your rent is going to be higher. And they were paying us $750 a month towards their option consideration, which goes towards their down payment when they qualify. that gave you $2,600. That's my bottom line there. Shows $2,600 of money coming in, less the rent, the mortgage payment and the, can't think and talk, mortgage payment, taxes, and insurance. This slide is not perfect for what we're talking about today, but it's a way to say if you have that $500,000 property, 20% down is going to be $400,000. Your mortgage is going to go up. You're probably going to be getting more than $10,000. I know that the Olivers get way more than 10 grand towards the types of properties they're buying there, which will, again, the more money you get up front from your tenant buyer, the less seed money you have into that property. You can probably dump this slide, Donna. And at that point in time, your return on investment keeps going up. And I know the Olivers, from watching how they do it, they will structure rents almost in conjunction. This says to say, Mr. and Mrs. Tenant Buyer, the mortgage payments on this property are X, the property taxes, the insurance, we're going to base your rent on that amount. So they may be charging rent based more on actual costs than they are on market. And maybe it lines up with market and maybe it doesn't. In our case, we're using market rent to make it work, and it happens to make that property cash flow.
Well, it's a good point, Neil, that often folks who are doing rent to own have money. They have money. Often the reason that they can't qualify for a mortgage and buy their own property is not that they don't have money. It's that they can't meet other bank qualifying rules because new business, new Canadian, new job, blah, blah, blah. But they've got lots of cash and they can pay big chunks of money up front, which certainly defray the cost of buying the property. And when your joint venturer is being asked in a tougher market to put up, 100 grand for at least 100 grand, maybe more, maybe 150, maybe 200 on a 20% down mortgage. If the tenant buyers are putting up 50 or 60 or 100 grand, that lessens the blow and shoves the cash flow up amazingly. So these can work in more expensive markets. It's a matter of what people are used to in the market, and the theory is the same. You just scale the numbers differently. So Neil, thanks for that. And now, Andrea, you have another spreadsheet to show us and another example.
I do, Barry. Hang on. I'll share my screen here.
She's better at share screen than I am.
Only because I've had to do it more. So here was another tenant first. And again, when I was doing an open house for a rent to own at another property, I met with a client who's had money, but wanted to choose their own house. So Barry, we went shopping. And again, I found a joint venture partner. And one of the things that I like to do, and this is just a quick tip for people, is on my spreadsheet, I have an 80% loan to value, 75% loan to value, and 75% loan to value commercial mortgage. So that depending on who my joint venture partner ends up being, we kind of know what the math is for each of the different scenarios, because my joint ventures are typically the ones that are also qualifying for the mortgage. So I did want to mention that. So we had a $10,000 rent-to-own deposit that was applied to the total amount of down payment and our closing costs. So the investor had to put in $54,000 to close. Mm-hmm. So we have our year one rental income, monthly mortgage, tax, insurance. So again, a decent monthly cash flow. That's with no extra money other than paying the market rent. So our first year sale price was $3.25, and we had a rough profit of $14,000 because we did a 1-year term so that we could then renew for a second year if it went into a second year. So cash flow of over $5,000, principal pay down of $77,000. So if the clients purchased in the first year, the $27,000 profit, I actually did a 70-30 split in this case where I was 30%, partly because I made a nice profit as being the buying agent realtor. So we kind of maneuvered the numbers so that he felt like he got a fair shake at it too. So his portion of the profit is $18,000, and so that would earn him a 35% return. Now, we did a 3% increase to be very conservative on this particular deal because it was in a smaller market than Red Deer. So it was in a bedroom community about 40 minutes away. So we just were a little bit more conservative. So again, profit, our cash flow, principal pay down. So the second year return on investment was not quite as lucrative because we chose to be a little bit more conservative in the second year. So our total return on investment between year 1 and year 2 is 65%. So it averages out about 32.5 per year. Now, when I was playing with the numbers to see what would make sense, I did analyze the 60-40 split, as well as, at different percentages of increase. So I chatted with my joint venture partner and said, I really want these folks to be successful. So here's what I'm recommending, but I want you to feel comfortable with it too. So this is some of the things that we do because we really want to make sure that our rent-to-own client is successful. And sometimes you need to work your numbers a little bit differently for the smaller markets. So that's why we did something slightly different in this case.
I like it, Andrea, that your spreadsheet is set up to look at how does it work with different percentages of money down, and also the difference between a residential mortgage and a commercial mortgage, because when you're putting a deal together and before you talk to your venturers, you don't always know which venturer is going to show up, and different venturers can qualify differently. So if you do it all at the beginning, you're ready for whoever shows up on your doorstep saying, yeah, I like the deal and this is how I can get the money. So that's a good idea. Instead of going, wait, I can just give me a second here, I'll tap out a few numbers on my spreadsheet. You're ready for them. So that's good coaching for folks watching.
We have a couple of questions.
Couple of questions. Okay, Donna, let's have them. Do you coach the tenant buyer to ensure they qualify for the mortgage at the end of the term? How to get a good enough credit score, ensure enough down payment, et cetera, et cetera. That's a very perceptive question. And Neil, what do you say about that?
100%. Bless you.
Thank you.
Actually, before we will even take people into our program, we do a pre-positioning financial statement, state of the nation, where are Bob and Betty nice today, and they're working towards qualifying and they can't. Why can't they qualify? We've turned down, we had a lady who applied to our program. She had $35,000 burning a hole in her pocket. And unfortunately, she was on a disability pension. And the amount that she was receiving from the pension would never have allowed her to qualify for our program. So to go back again, tie this back into the Abbotsford thing and the way the Olivers are doing it, folks, when you're in these higher dollar markets, you think about what it takes to qualify the average person to buy a $500,000, $600,000, $700,000 house. They have to have that ability to qualify down the road. So yes, are we coaching people? We actually don't. Let me stop that for a second. We work with third-party people, mortgage brokers, because we also want to make sure that it is, singers sing and dancers dance. I don't do my own lawyer work. I don't do my own mortgage broker work, because the experts in that field who absolutely know the subtle ins and outs of getting a deal approved at the bank level, a good mortgage broker and a bad mortgage broker can be the absolute difference between a deal getting approved down the road. So the mortgage broker, and I've said this for years, it's like if I want to run a marathon and I can barely run up and down the stairs today, I'm not going to start by running 26 miles tomorrow. But if I hire a performance coach who's going to say to me, Neil, we're going to start with you just walking around the block, literally, and I'm going to be puffing. But they're going to give me a roadmap to success for my physical training to run a marathon. And same if you want to become qualified to get a mortgage, We need to give them that financial roadmap for success. And the similarities between the two of them are a perfect analogy that everyone gets, because I think we all understand that physical fitness is important. I think we also know intrinsically, though, that the only person who can do my sit-ups for me and my push-ups and my running for me is me. And the only person who can work on a credit score for a tenant buyer, if that is one of the concerns, or debt servicing, is them. So we have made it mandatory in our program that they work with a good mortgage broker, which also, by the way, I'm sure we'll talk about this at the course at the end of the month. Do they always get to the finish line? No. So having a third-party opinion of what's happening gives you that extra layer of protection, so that if it ever went to a disconnect and a court case, we can actually say, well, here's the information that was given to us by a third-party broker. We don't get compensated by them. They're there to get you approved, and that's how they get paid. And that gives us that little bit of separation, that it wasn't us that said, here's what you need to do to qualify. It was certainly someone who has an expert in that field to do it. And then we do check-ins with them, because we have had so many of these people. We call it the minivan clause, which is no longer minivans, they're now SUVs. Well, my car wasn't working well, so I had to go out and buy a new one, and I took on a $900 payment. And you're like, oh, right? Because that's going to just throw off all their ratios.
Yeah, good point. Andrea, how do you, what do you do to try and help your tenant buyers make sure they can qualify in the end and actually buy the property?
Well, very similar to Neil, we use a mortgage broker who herself has done rent to owns, knows how to coach people through them. So before we even agree to take somebody on, they do have to chat with her. She puts together a nice 6-page document that says who the client is, what they need to do in order to qualify for this mortgage in the time period that they're looking at for the rent to own. So these people are worth their weight in gold.
There's the roadmap that Neil was talking about. So, folks, as you listen to Neil and Andrea talk about this, there's a lot of work to do in rent to own. There's a fair bit of effort that you have to put in. It can be, as you saw from those profit percentages that Andrea showed in her 3 examples, it can be very, very profitable. And seriously, once you've done one of these with a venturer and had it turn out exactly the way you said it would turn out, they will be coming back to you for any deal. They're always a good bet when you have another possibility to talk to venturers that have worked with you before, and they're happy as clams to come in on another deal. And as Neil pointed out, they don't even want the money back. They want you to keep the money and put it to work for them. Okay. So that's really important. Donna, what else we got? Couple more questions. All right. How do you find these tenant? I can't quite see on my screen here.
Tenants who can go for, how
do you find these tenants who can go for RTO? Well, folks, that's a big part of the Rapid Cash program coming up on May 27th, 28th in Edmonton, is the marketing aspect. How do you find people for rent to own, or where do you find agreements for sale? How do you find deals to do wholesaling? That is a really important part of creative real estate, because if you can't find a deal, you can't do a deal. So it's a process about how you market and how you find, and we talk a lot over an extended period of time at Rent to Own on the specifics of how you find folks. But maybe Neil and Andrea might have a nugget. I'm not going to tell you everything today. To show up on May 27th and 28th, but maybe there's a nugget. Neil, what do you have for give these folks one idea about how to find tenant buyers?
Today we rely on our website, but for someone who's starting out with one property who maybe doesn't want to take the funds to build out a website, or then figure out how to drive traffic to it, because driving traffic to a website is a whole weekend seminar in and of itself. We started out, quite frankly, just putting in the local platform. Kijiji or Marketplace or Rent Faster is big in Alberta. I don't know about Ontario, but there's a rental site there, and we would actually just put it into the script: rent or rent to own, or rent to own only available on this property. And we'd put a bandit sign in the lawn if it was a house saying rent to own opportunity, handwritten sign, and it worked for us. And there's a progression that went from those very basic versions to where we are today. But there's nuggets, anyways.
That's a couple of nuggets. Andrea, you have one little
Yeah,
thing.
doing the open houses was really successful for us because people out of curiosity would come by. So again, we would stick signage in the neighborhood and invite people in, and people are curious. And, between that and Facebook Marketplace, you're pretty well covered.
So that's really good coaching, because rent to own actually has quite a high profile in Canada. Rent to own, by the way, folks, works across the country. It's not just Alberta or BC and Ontario. Rent to own works all the way across Canada. Slightly different things you have to know about, provincial differences, but it does work all the way across the country. And so you don't have to go into huge detail in whatever you're doing to draw people into an open house for a property you already own, or as Neil said, to put something up on Kijiji or Facebook Marketplace. If you say rent to own, most people who are looking to buy property have some idea what that's all about. So that makes it pretty easy. You don't have to create elaborate advertising and go, oh my God, what are the keywords the keywords are rent to own, and you will have people showing up who want to hear what the rent to own opportunity is that you are offering. So there we go. Donna? Couple more questions. Do we need to compensate the mortgage broker for arranging that agreement? I guess Praveen is probably, Andrea, talking about when you put together your proposed tenant buyer with the mortgage broker ahead of time to see whether the broker thinks. Tell us what you do for your mortgage broker.
No, actually, how I kind of repay her kindness is I send her lots of referrals for other clients. So, okay. Yeah, but she gets paid when she does the mortgage down the road for the rent-to-own client.
So you would send other people to her, plus she'll do this mortgage, and mortgage brokers get paid. Now, folks, if you don't have a relationship with a mortgage broker like Andrea does, as long as you find a mortgage broker who understands rent to own, you can negotiate with them that for a sum of money, they will take your proposed tenant buyer and run them through the program to see if they qualify. So you can do it a couple of different ways. What's next, Donna?
Okay. Let's do this one next.
Let's do this one. I'm in the NWT, pretty much a rental market. Typically what you said, Barry, folks have money, but just moved into the territories, can't qualify. Would you open to a chat and see if RTO can be safely introduced here?
It's in our documentation, I believe.
Donna says it's in our documentation, but what I can say is rent-to-own does work across the country. It'll work in the NWT just the same as it works somewhere else. It's just a matter of what the kind of territorial niceties will be for how it works. But if you send something to Donna, and if we need to talk further, certainly we can have a chat to see if we can help you out.
Okay, one more.
Okay. So, question: are you guys members of the RTO professional organization? I'm not a member, although I have spoken at what I think is the leading RTO organization. I've spoken at their conferences. I'm not sure if Neil or Andrea are members.
I'm not a member. When they first launched, we were fairly far down the road, so we didn't join at that time. And I think if it's the organization you're referring to, they actually just had a conference about 2 or 3 weeks ago, and I was actually going to pay to just be a virtual participant in it, but ended up with other priorities, unfortunately, just to see what's new in that world. But to answer the question, no.
No for me.
Not for me. So if you are interested in really getting into the RTO space, the one RTO organization I'm thinking of, which I can't remember the exact name of it. CAROP.
Yeah.
CAROP. It's a good organization.
I was going to say, I saw Donna Cook on here, and there's Donna. Donna is part of CAROP.
There's Donna. You can get a recording of the recent summit. So that's a great organization. very experienced RTO operators in there. They're quite helpful. We like them because they help each other the way we help everybody in our group. And so I would recommend joining CARIP if you really want to get going in the RTO space if you move along. Any more questions, Donna?
That's it.
That's it for questions. Well,
Everybody's going to the game.
everybody wants to get off and watch the Oilers thrash Las Vegas again.
We one Canadian team with a hope.
We hope. We hope so. Neil, thank you very much for coming on in support here. Andrea, those were wonderful spreadsheets. Really good to see how you organize things with your spreadsheet and to see the differences from year to year, how you can move the numbers around to make sense for people, and how you turn things into a win-win, both for your ventures and for the tenant buyers. So that was very instructive, Andrea, and I just love it when you come on. So anybody watching, Neil and Andrea are both going to be at the Rapid Cash program here in Edmonton, May 27th and 28th. They are focus team leaders. They come along. They're there for the full 2 days. And we hear a lot more of what they do, actual things that they do in their real estate businesses, their creative real estate businesses. So I strongly recommend that if you want to carry on in the creative real estate space, that you give strong consideration to showing up on May 27th and 28th. You will not regret it. And that is for sure.
The difference that program can make in your life financially with financial freedom, folks. Andrea and I were both buy and hold landlords when we first started into this arena, and it has changed my life. And I won't speak for her, but I kind of know her answer to this one too.
Yes, Andrea, what do you say to that?
Absolutely.
All right. And that's it. Thanks, everyone, for showing up.
One more question.
Oh, one more question. All right. What do we got?
Yes, and the answer is yes, we have the spreadsheet as a template in our.
What does Andrea use for a spreadsheet? Well, guess what? You get Andrea's spreadsheet when you show up at the Rapid Cash program, along with a whole bunch of other tools. So don't worry. All of that will be supplied. All right. And on that note, time to say goodnight. Thanks again, everybody. Thanks for showing up. And we'll see you next time. Good night, everybody.
Nice testimony.